Welcome into the channel, folks. After years of debate and thought about a recession, I'm here to tell you today it is officially here. The recession is here. It's everywhere you turn at this point in time. And no longer can we say it's just there's weakness out there or some businesses, the growth rates aren't quite there. No, we're getting too many large companies to come out and tell us that their revenues are literally going negative now at this point in time. So we're going to cover that. We're also going to talk in this video, how does this happen, right? Public count, I believe today just hit a new all-time high, right? $2.21 million, up $28,000 here today. So how is that happening when we're now in recession, in my personal opinion, right? And then we're also going to speak about what you need to do in this market to avoid some major pitfalls and take advantage of this next bit of time we're going to be going through, this next 6 to 18 months, because it's very, very important you take advantage of certain opportunities out there in the market, okay? Appreciate you guys joining me as always. Thanks so much for being here. It's an in-depth beast here for you guys here today, and I want to welcome the 1,500 new subscribers that have joined us in the last 28 days. Also, new all-time high for subscribers in the history of the channel. So I appreciate each and every one of you that are subscribed here to the channel and that smash that like button each and every video, okay? So right off the bat here, this came out here today, Walgreens to close up to a quarter roughly of its 8,600 stores. This is pretty shocking because this is going to mean, if they're going to do this is going to be over 2,000 store closures, which is a pretty shocking number. It's going to negatively affect tens of thousands of jobs. It's not like this is a small amount. This is like a substantial, right? Walgreens Boots Alliance will close a significant portion of its roughly 8,600 U.S. stores as a pharmacy chain seeks to turn around its struggling business, which has been hit with inflation-weary customers paring their spending. The current pharmacy model is not sustainable, says the newer CEO there, Tim Wentworth. With 75% of the company's U.S. stores accounting for 100% of its adjusted operating income, the company plans to examine the remaining 25% of stores for closures, right? I mean, this is scary, and the reason this is scary, it's not just about, wow, there's going to be a lot of jobs disrupted in this, right? But the other thing that's scary is for a company like Walgreens, one of the big competitive moats Walgreens had over the years. If you don't understand this company, I used to be an investor in this company. I used to work for this company, and I understand like one of the big competitive moats for Walgreens was, guess what? Having a huge store network. And the reason that was so important is you could go to any city, any area, and there'd be Walgreens all over the place. And so it made it very easy if you were traveling, if you were moving somewhere, to get your you know, whatever you needed from the pharmacy, essentially, right? And the drive-through, that was another huge competitive moat around that. Well, if you're going to close 2,000 plus of your stores, you just made it more, your customers' lives more inconvenient, which then starts getting to a bigger cut and bigger cut. And next thing you know, your stores start underperforming even more. And then you got to cut another 1,000 stores, another 1,000. Next thing you know, do you even have a store model anymore at that point in time? Now, the other thing is, you know, this could affect 50,000 plus direct jobs, right? But the question is, how many indirect jobs? And as somebody that used to work for Walgreens, there's a lot of people that make money from Walgreens that aren't Walgreens direct employees, and they make money from the company. The folks that do signage for Walgreens, right? The lighting, exterior cleaning, like we weren't out there cleaning the parking lots like the Walgreens employees. You used to hire a company to go ahead and do that, right? Painting of the stores, exterior, interior, and all the maintenance that has to happen with the stores, right? Registers, equipment, phones, computers, all those sorts of things. And that's all going to be disrupted now at this point in time. And the other thing that's going to be disrupted, and this is more of a long-term thing that's going to be disrupted, is actually pharmacists. So pharmacists has been I think a great industry over time for people to get into if you want to make 6 figures a year. Like the median annual wage for a pharmacist is $134,000. That's always been an industry that it's like, you know, get into that. You've got a guaranteed job. You're going to make 6 figures a year. It's going to be gravy, right? But I think this is actually going to be disrupted. And the reason being is I think what happened today signals, I don't want to say it's the end of pharmacists because we're always going to need pharmacists, but in terms of the incredible demand for this industry over the past, 20, 30 years, that's going to slowly start to come down. And the reason being is a lot of what's going on here with Walgreens is going to shift to other companies, and these online companies are not going to hire even remotely close to as many pharmacists as somebody like a Walgreens used to. That's one of the big advantages for them, is they're going to cut down on costs substantially. They're going to use programs, they're going to use machines, and they're going to get around the system to not use nearly as many pharmacists overall, right? And Amazon's really going to be a direct beneficiary of this. Amazon stock, we're now up $95,000 in this position. We're going to be up a lot more in the future, and Amazon's going to be They're going to become, it's pretty clear to me they're going to become long-term the pharmacy giant of the United States of America, right? And so that's just all a process that's going to play out over many, many decades. And, today became very, very clear. And the thing that's scary about Walgreens is their pharmacy business is actually pretty good and relatively stable. The reason they're going to have to close thousands of stores is because the rest of their business is doing so bad, right? Which is kind of scary. Now, there's a company named Pool Corporation that, unless you're in the pool business, I would say probably 95% of you guys never heard of this company before. But it's a very important company if you want to know what's going on with the economy. Pool Corporation, the world's leading distributor of swimming pool supplies, equipment, and other related outdoor products. So this company just tore down all their guidance, all their numbers, what they're expecting for this year. It's bad. But here's the deal, okay? The bigger challenge is on new build and remodeling work, where Pool has been forced to cut guidance. It expects new units to be down 15 to 20% and remodeling be down 15% versus a prior guide of flat to down 10%. Now in Q1, management saw permits down 15 to 20%, but believed they would be an improvement, which simply did not materialize. So this pool company essentially, how do I put it simply? Like, people aren't going to be building nearly as many pools or remodeling pools, okay? The numbers are not going down a little bit. I mean, we're talking about 15, 20% down on a year-over-year basis, right? And we're talking the business is trending much worse than management expected, which then makes you think this company is not even close to a bottom in terms of this. It's actually going to probably get worse for them over the next several quarters. When management is so far off like that with their guidance, it likely means the business is going to deteriorate quite substantially more for at least the next 2 quarters, if not up to the next 4 quarters for this company overall, which is bad. Now, if you know me, you know I grew up in the pool business, right? My dad had a pool cleaning business, and then he also would do repairs and also do remodeling. And I would go to work with my dad all summer long, every single summer, right? And so I learned in that business that, if we looked at that business prior to 2008, when people went, like my dad had a lot of customers coming to him prior to 2008 that would want to get their pools remodeled. And it was like my dad never sold them on it or anything. They came to him and said, hey, I want to remodel my pool. Then my dad would kind of be the guy to make sure everything goes right? And, basically contract a likely pool corporation, and those workforces would then be the ones to go do the remodel. He was just kind of the guy overseeing it, right? And he would kind of get to make a fee off that. And they were coming to him left and right prior to 2008 because a lot of folks were looking at it and they're saying, yeah, if I spend whatever amount of money remodeling my pool, it's an investment. And that's the way people would look at it. It's not an expense. If I spend, $5,000, $10,000, whatever amount it is, right, on remodeling my pool, it's an investment, right? But then 2008 to 2011, I don't know if my dad had even one customer reach out to him to remodel their pool, right? And the good thing for him is he's got that stable, obviously, recurring business, which is cleaning pools. But in terms, and, problems happen with pools, filters break, motors break, things like that. But in terms of people wanting to remodel, no one's coming to him to remodel their pools during that particular time. And the reason being is now people started to look at it as an expense over an investment. And his customers wasn't like they lost their jobs because he works, pretty much all for retirement folks, right? But here's why. If you look at what happened in Phoenix, Arizona with real estate pricing back from like 2000 into 06, 07, right? I mean, prices went up, they skyrocketed, right? And so this is why people did not mind remodeling their pools back during that time, because they're like, hey, if I spend $5,000, $10,000, $20,000 on this remodel, it's an investment. Look at how much my house is appreciated. It's nothing for me to spend money remodeling it, right? But then when real estate prices crashed massively, this is why no one was coming to him and saying, let's remodel my pool, because they're all looking at it and they're like, why would I put money into this thing where, it just loses value, and it's lost, 40, 50% of its value over the last few years, right? That's important to understand that. Now, that goes way beyond the pool industry, and that's the same thought process that goes into somebody going to spend money on remodeling their home, doing this or that, right? Which then starts to hit Lowe's numbers and Home Depot numbers, 2 of the biggest retailers, obviously, in the United States overall, right? And the amount of jobs at Home Depot and Lowe's, there's a ridiculous amount of jobs they directly impact, but also indirectly, right? All those folks that are going to shop at Lowe's and Home Depot and all the contractors, right? If these companies' business is down, that means the end contractors' numbers are down as well, right? And sometimes it can be down much, much more. And if you look at Home Depot's latest numbers, it's very, very clear. Their net sales are negative year over year. Only way Home Depot's sales go negative is in a scenario where we're in a recession. There's no other way to put it. Like Home Depot sales should never go negative. The only time they're going negative, and especially think about inflation and think about, Home Depot's, I guarantee you Home Depot's raised price substantially on pretty much everything they sell. And so this means transactions are down likely a lot larger than actually how much sales are down, right? Operating income for Home Depot in the latest quarter down 8.5%. What about Lowe's? Maybe it's just a Home Depot thing. Lowe's, oh my gosh, it was way worse for Lowe's. Comp store sales, comparable store sales down over 4% year over year. That's a disaster. Your comp sales should never go down as a retailer. But if they do, maybe 0.5%, maybe 1 percentage point, maybe 2 percentage points. 4% plus is a disaster. Lowe's and Home Depot are screaming recession. These companies should not have comp store sales. And remember, like I said, they've raised price. I bet you on almost everything they sell there. So the fact that that comp store sales are this week, revenues that week, when you went up on price likely, that means transactions are down substantially, which means at the end of the day, people aren't putting money into their homes to remodel, right? Now, if you know me personally, I'm putting in money to my house right now to remodel, right? I'm doing all types of stuff, doing custom closets and lighting, changing the whole front yard of the house, having a pool and spa put in, and a fountain and all these different things, right? My backyard looks like a brick warehouse right now, right? Putting in a built-in barbecue, doing all types of stuff. Why am I doing that right now? Well, because other people aren't doing that right now. And this is when you actually get good deals in the market, and this is when these contractors and these folks actually need business. You don't want to go to these folks in 2022, 2023, they treated you like trash. You were just another number to them. There was nothing there, right? Service was horrible, and all those sorts of things. Now you go to these folks, and they actually need the business, right? Which puts you as a customer in the position of power. And so if you're wondering why I'm getting so much stuff done to my house right now, I look at it and I say, this is a great time to do something like that. Whereas a lot of people, we're running out there to do all these remodeling jobs and all this stuff back in 21, 22, 23, and they're paying ridiculous prices for this stuff, like absolutely insane pricing, and they got a lot of bad work done because the contractors were just rushing through jobs to try to get to the next one and the next one because they had so much work, and you couldn't get any respect from these folks because they had so much business. Like, who cares? Like, okay, I don't do your pool, I'll do somebody else's. Like, there's so many jobs out there right now, but not now. And so, this is where you got to kind of play these games of understanding patience, right? And so I was watching everybody do all their stuff a couple of years ago, and I'm like, okay, y'all do that. I'll do mine when things calm down a bit, right? Now you look at pending home sales, right? I mean, it's like lowest we've ever seen it. Lowest we ever seen it. That's about as recessionary as you get. The home market's dead right now. If you're a realtor, if you're a mortgage broker, if you're anybody in the real estate industry, this is honestly as bad, or if not worse, than anything you've ever seen in your career right now, right? Let's be very clear about that. I honestly don't know how a lot of realtors and folks are making it right now. I really don't. Like, this to me looks worse than the Great Recession, far worse than the Great Recession. I don't know how those individuals are making it. It's brutal. I mean, absolutely brutal, right? Now, I will say, if I was looking for a property, I'd buy over the next 6 to 18 months. Absolutely. I'll likely be buying a real estate property probably next year in 2025. I think this is going to be a buyer's market for at least the next year. I would say at least the next 12 to 18 months, we're going to have a buyer's market. Inventory is rising substantially across the board in a ton of markets now at this point in time, right? And finally we're at a point in time where the sellers they've completely dropped out this year, right? The folks that really were desperate to buy, they bought in 22, they bought in 23, and now, they're gone. They're absolutely gone. And so the buyers are now in a position of power for the first time in a while. But keep in mind, you're going to be in a position of power really for the next 12 to 18 months. In my personal opinion, I think it's a great time to be buying over the next 6 to 18 months. Southwest Airlines, arguably the most famous airline in the United States of America, and this is a heavy domestic company. Okay, and it's important to understand why their numbers matter, I think, more significantly than, let's say, Delta or United or some of the companies that might fly a little bit more international. And the reason being is when it comes to Southwest Airlines, since they're so domestic, they're not benefiting from all the folks that are traveling international that weren't doing it, back in 2020, 2021, and even 2022, because a lot of people were kind of a little wary about doing that international travel. So when travel finally started to get back going in 2022, after Rona became a thing of the past, people really focused on domestic travel. And then 23 kind of got going more international, and 24 as well. So international is kind of just in a little bit of a boom time right now from kind of the holdback from Rona, right? Whereas domestic kind of got the wheels going first. So Southwest, since they're so heavy domestic, I think they're really important to pay attention to what's actually going on in the economy, right? And in terms of Southwest, this just happened yesterday. They cut their second quarter revenue forecast, citing changing booking patterns. Meanwhile, the cost of their doing business has gone up substantially for them, 7.5%. That's kind of stagflationary, right? When your customers are backing out, but then your cost of doing business is up substantially. Southwest expects revenue per available seat mile. The amount the airline brings in for every seat it flies 1 mile will fall between 4 to 4.5% in the second quarter over last year, after previously estimating a 1.5 to 3.5%. So there's another company here that's a big, substantial company that is basically saying our business is far worse than we expected. When management teams are way off in terms of how bad they thought things would actually get for their business, you're likely going to be in for even worse numbers the next several quarters, as I explained with Pool Corporation. So don't be surprised when it comes to Southwest Airlines if their numbers continue to get far worse over the next couple months now at this point in time. No different than if a management team expects their business to be here and it comes in way better than expected, expect also much better numbers the next several quarters. The opposite's true in a situation where you're in declines, right? Now this leads us to FedEx. Here just a week or two ago, FedEx basically said they're going to do a big workforce reduction in Europe, talking about 1,700 to 2,000 jobs. FedEx is only going to make a move like that if their business is not in the best place, and if they feel like it's not going to get better really in the short term here. That's why they're going to make a cut like that, right? Now, if we look at FedEx's latest numbers, this is FedEx Express, right? I specifically want to show you this here. Total average daily packages, down 1% year over year. FedEx should, in theory, because, we're talking about FedEx does business all over the globe. There's so many more transactions done, packages going around. E-commerce continues to just get more and more popular every single year. FedEx packages should go up in theory every single quarter, every single year. They should never go negative. The only reason a company like this would ever have their daily packages go down year over year, considering the e-commerce industry just gets bigger and bigger every year, is if you're in a recession. And that's exactly what we're seeing. Daily packages for FedEx down year over year. UPS, when they had reported their latest numbers, it was a complete dumpster fire. Revenue's down 5.3%. I'm sure their packages were down huge. I had trouble finding the actual number in terms of how many packages, but in order for their revenue to be down 5.3%, the amount of packages they're sending must be down substantially. Their operating profit was down 36% year over year, right? UPS, FedEx, these sorts of companies, they are the economy. When they have their revenues going negative, packages going negative, like what are you doing? That's bad, right? Meanwhile, there's Airbus. This just came out 2 days ago. Airbus shares plunge as plane maker cuts profit forecast. And if you ever thought about the company that was the most well-positioned in a marketplace, listen, there's two companies that dominate the complete airline industry in terms of selling airplanes. It's Boeing and it's Airbus. Boeing's been plagued with problems for 5+ years now. Every time you hear, it seems like every week there's another negative article about Boeing coming out or something Boeing did wrong, right? And so if you ever thought about a company that really has a monopoly on the industry and they really only have one competitor, but their other competitor is just a complete dumpster fire right now. Airbus is in the perfect situation. The fact that this company had to have their shares plunge and had to cut their profit forecast is what is going on? That's insane to think about, right? Now, meanwhile, it's not doomsday everywhere you look, right? Because you look at this here, this headline, Metro Phoenix's West Valley's building boom spurred by TSMC. Well, yeah, if you're going to build one of the biggest semiconductor factories in the world, well, that particular area is going to benefit from that, right? Vegas, I saw, a gentleman who talks about real estate recently, and he's like, I don't understand why Vegas inventory is not flying high. I don't understand why that market's not getting hit. In the great financial crisis, the inventory went crazy. It was one of the hardest hit housing markets, right? And he's showing all the other housing markets that are kind of the quintessential, housing markets that you think would get hit. But here's the deal with Vegas. You got to understand things on a case-by-case basis. Vegas, not nearly as reliant on strip and tourism like they used to be, right? And then the other thing with Vegas is we've had so many people from California move out here, from LA, from San Francisco with a lot of money move out here. And so those folks, I mean, it's cheap for them to live out here in Vegas versus what they were spending over in LA and in San Francisco and in those sorts of places. So they've brought so much money over here that they continue to just spend in the economy. And so you have a state that the economy is much more well developed now, in a city specific that's much more well developed, and plus all that California money. That's why you're not seeing doomsday for Vegas real estate, and why you're honestly not going to see doomsday for Vegas real estate. And plus, so many of these folks with California money, there's a lot of us that are waiting for prices to try to dip here in Vegas, and we're just not seeing it, especially in the areas that you actually want to buy, right? Now, you look at companies like Elf. Certainly seems like no recession for this company. The stock just goes up. It's up another 6.5% today, up $13,000. There's no recession for Elf, right? I mean, they just run their business on a higher level than anybody else in the cosmetics industry, and their price points are incredibly attractive for their products. So they just continue to steal customers from their competitors, if anything. Palantir surely doesn't seem in a recession. The stock up another 4.6% today. We're up 185% now on that stock. There's no recession for Palantir. Why? Well, because Palantir does business with massive companies, right? Big businesses. Those big businesses need Palantir's software. They need Palantir's products. And so Palantir's business continues to accelerate, even though we're seeing just thing after thing after thing showing that there's a recession actually happening now at this point in time, right? NVIDIA, I mean, the company's pretty self-explanatory. They are certainly seeing no recession, right? But who's NVIDIA's customers? All the biggest corporations, the most powerful corporations in the world, and they need NVIDIA's chips, right? Meta's very different than it was 10 years ago, right? Meta continues to benefit because a lot of the companies that or advertising on Meta, it's not just small businesses like it used to be 10 years ago. Now you've got massive corporations that they have a certain amount they have to spend year in and year out on marketing. Maybe it's $1 billion for a company, right? And Meta just continues to gobble market share. And they continue to steal marketing dollars away from traditional media, from old school ways of advertising, and people just realize you're going to get a lot better ROI if you're spending on Meta's platforms, if you're spending on Instagram, if you're spending on Facebook, right? And so it's very different. And so Meta just continues to be in a sweet spot because they benefit from small business advertising, but they also benefit now from large business advertising. Oh, and we're going into political season now. Guess who's going to be the biggest beneficiary of anybody when it comes to all this political ad spend? It's going to be Meta. You want to give money to your candidate, right? Or whoever that is, whether it's more local elections or more federal type elections. Okay, you can give that money, but just understand you're really giving the money to Meta, because those folks are then going to turn that money and advertise, put all those commercials on different places, right? All those ads, making the other candidates look bad, making themselves look good. And guess where they're going to spend that money? They're going to spend it on Facebook. They're going to spend it on Instagram, where people actually are, right? Now, meanwhile, you're getting more and more information about recession being here, right? Outside of just companies' earnings and what companies have their revenues going down. Look at this delinquency rate on credit card loans, right? And check this out. I mean, we're by far and away the highest in the past 10 years, and I don't think this has peaked yet. I think it's actually getting far worse over this next few quarters here. So we're talking about credit card loans going bye-bye now at this point in time, right? And why do I feel like it's going to get worse? The reason I feel like it's going to get worse is with interest rates where they are right now, and with the consumer backdrop where it's at, inflation is still too high. People are getting nailed with crazy increases in their car insurance right now. I'm looking out there and I'm saying credit card losses will actually get worse in the short term, okay? And so I expect this number of delinquencies actually to continue to go up this year. And like I said, we're already the highest we've been in 10 years. To really find this, you kind of got to go back to the great financial crisis to find delinquency rates as high. And once again, we're going higher in regards to this, right? Also, auto loan delinquencies have recently hit the highest rate in a decade. So this is another telltale sign when you see people not paying their credit cards, when you see people not paying their car loans, right? That's basically a telltale sign that you're in a recession at that point in time, and that's exactly what we're seeing, right? That leads us to kind of what to do in this market, like where to invest your money, how to view a market like this, those sorts of things, right? Well, let me put it to you like this, right? Let's say we have person A and we have person B. Who would you rather invest in out of these two individuals? And I want to break it down like this because it's going to allow you to think about companies a little bit differently, right? If I told you person A, they have $200,000 in assets, they have $5,000 in liabilities, they have $100,000 income last year, and then projected income this year is $115,000 for person A. Then we have person B, $5,000 in assets, $200,000 in liabilities, $50,000 income last year, and then they have a projected income this year of $45,000. Which of these two individuals would you invest in? Anybody? I hope that every single person watching this video right now, each and every one of you, 30,000, 40,000 people watching this video right now, I hope you said this person. Please, please. Oh gosh, if you said person B, I don't think you should do this. I don't think you should invest. I think you should hide in a hole somewhere, okay? Everybody should have said person A, but that's easy, okay? What if I said you have to pay 3x the price to invest in person A versus person B? And I said, if you invest in person B, you get a big discount for investing in them. I still hope you said, okay, even if I got to pay 3x the price, I'll gladly invest in person A. They have their stuff together. This person B's a mess, okay? I hope we'd all say that. And so the way I just ran you through that is also the way you got to think about your investments in terms of investing in companies, right? Because there's going to be a lot of companies that are going to give you big discounts. There's a lot of them in this market right now. And when you're in a recession, that's what happens, right? And that's why you see so many stocks down 30, 40, 50, 60% right now, right? And they're giving big discounts. But at the end of the day, sometimes you got to pay up for the actual top tier quality because, it's just a lot easier to invest in that high quality versus the kind of mess and hope and pray it turns around and becomes person A, right? Now, we also look at consumer sentiment. It's horrible, but it's not like it's new horrible. It's been horrible for really 2 years now at this point in time. Michigan consumer sentiment, they've been doing that for such a long time. These numbers have been horrible for 2 years. Honestly, they've been bad even back in the Rona days, so they've really been bad for 4 years. Now at this point in time, 4+ years, but they've really been ugly the past 2 years. Like we hit all-time lows pretty much, right? And so what this shows me is when you invest in companies, you've got to invest into strong brands, especially if they're doing business with the consumer. And you've got to invest into companies where their customers have a lot of money. So let me put it to you like this, like a Palantir, right? Well, Palantir does business with big companies. Well, their clients have a lot of money. Great to invest into, right? If I think about NVIDIA's been a great company to invest in because even though consumer sentiment's been horrible, guess who NVIDIA's biggest customers are? They're Amazon and Meta and Microsoft and all the biggest companies in the world. Their clients have money. There's no shortage of money for those companies, right? So same way I'd also think about it for companies that are doing business with consumers, right? You look at Honest stock's up 68% in the past year, right? I think it's probably going up a lot more over the next year. And I look at an Honest, and why? Well, their financials have improved dramatically. Their revenues are going up very nicely. And Honest's customer base has not been hit by inflation as bad because Honest caters much more to the upper middle class than, let's call it, the true middle class or under the true middle class, like a lot of other brands might, sell to. So Honest has been doing very well, even though its consumer environment has been horrible, right? Wynn Resorts, although the stock price hasn't done a thing, so far this year, their customer base seems fine. Wynn caters to the top 10% of income earners, the top 10% of the wealthy, right? And so they've been benefiting in the United States with their properties. They've been benefiting in Asia. The Macau properties are doing phenomenal, and Wynn's going to continue to do phenomenal, really regardless of kind of what's going on here and regardless of these consumer sentiment numbers and regardless of credit card delinquencies being, up where they are and auto loan delinquencies being the highest in 10 years. Wynn continues to put up phenomenal numbers. Elf on a Shelf, up 101% in the past year. This company, it doesn't really matter that, credit cards are here and this company's revenues are going down. This company's revenue, Elf puts up their numbers regardless in this situation, right? So what you need to do is you got to look for deals, right? Look for deals out there. Take advantage during this time period, and don't look back with regret in this situation because a lot of people, when they go through recessions, when they go through, a lot of stocks being down, which let's be very clear, there's a massive amount of stocks down huge right now. The markets are at all-time highs, but let's be clear, that's just because of, the very top of the market is doing phenomenal. But, in this sort of market, take advantage of this time period. Look for deals. There's deals everywhere out there, right? And continue to take advantage of those deals because there's plenty of them out there. There's going to be more, and you want to make sure you know what you're doing and take advantage of the quality, though. That's the big thing. The biggest quality, the companies that are selling to customers that they got the money, okay? Very, very important. Now, every July 4th, I usually do a deal on something. I usually do a deal on a course or something like that, usually for Black Friday and for July 4th. What I decided this year is, since it's the founding year of 1000X, I'm going to do a one-day sale 4th of July. If you want to enter for that deal, that will be the pinned comment down there, and we'll send over that deal. Essentially, enter in your name, your email, and we can email it over. If you want it sent to your, like a text over, then you can put in your number there. We'll text you over the deal when it drops on July 4th. And you're not only going to receive the service, but you will receive the founding member steel card in the mail as well, which everybody that joins, since this is our first year launching 1000X, everybody that joins this year will get a founding member card in the mail to your house or your apartment, your condo, wherever you live, essentially. Okay, so that'll be pinned comment down there. Alrighty, guys, appreciate you joining me. Recession's here. Much love, and have a great day.